Hello and welcome. My name's Andy Crook, and I'm hosting tonight's live training on why your accounts are not a reliable metric. So, before we get into the live training today, just like to say a little bit about the Atomic Success Program, which runs in the background of the Garage Owners Network Group. So, what our little program does is it asks you to focus on some of the stuff that we talk about in the live training. And it all came about because I wrote a business course called The Business of Diagnostics. And from writing the business course, I started getting more and more interested in the business side of the training. And I decided I would like to expand away from the business of diagnostics and look at the whole business as a garage, as an independent garage business. I wanted to look at the whole thing and see how we could improve things. And what I discovered was, instead of trying to make massive changes, the thing we need to do is make small changes, incremental changes. And hence the name Atomic Success Program was born. So that's what all this training is about. It's about making small changes in your business. So the decision was made to give away the training for free, in the form of these short videos. And then if you need help implementing any of the things that we talk about in your business, that's where the program comes in. And it's basically a series of videos and templates that you can implement within your business with ongoing support. And that's the idea behind the program. So enough about that. Let's talk about tonight's subject. Why accounts are not a reliable metric. Well, we all measure two things in our business, or I hope we do, and that's we probably measure our turnover and our net profit, and they are probably two of the most important metrics because they're kind of the outcome of the business. It's how much money we took in as a business, which is our turnover, sometimes called the revenue, and how much profit we made on that turnover. And they're two sort of metrics that everyone measures. But not everyone talks about their net profit because it's sort of top secret. I don't know why it is, because for most businesses it can be predicted, and everyone talks about their turnover. And there's a famous saying, and we'll do a training about it at some point, I'm sure. And it's turnover for vanity and profit for sanity. So that's the saying in business. Everyone talks about their turnover because it's such a big number. You know, I did X million for my little business, or I did so many 100,000 in my little business. They never talk about the profit they made on their turnover. That seems to be a sort of a secret. However, it's if you have a look at some data, you can probably work out what most small businesses make as a profit, and it sometimes makes pretty grim reading. So, for a start then, what do we know about our accounts? So normally what happens is we do the work, and the very first job that we sort of abdicate in the business, the first responsibility we give to someone else, is the bookkeeping. It happens time and time again. Now, you may have someone who's qualified in bookkeeping doing your books, or you may have someone who you just get to tidy up your mess. By your mess, I mean your invoices, your credit notes, etc., etc. And they post that onto a system, some sort of, it could be a garage management system, it could be an accounting program, whatever it is, however your business works. Nowadays, generally, most bookkeepers work on an electronic cloud-based accounting system, whether that goes through their garage management system or not, it matters not. And what you get then is normally a number of financial reports, which then go to your accountant, and your accountant is only there in your business most of the time as a legal requirement. Would you actually pay your accountant if it wasn't a legal requirement to present your accounts in a way that keeps you compliant for reasons of tax and satisfying legal and legislative purposes? I'm probably sure I wouldn't pay mine. So, a bit of news about your accountant. So in most cases, and not all, but in most cases, your accountant is obsessed with getting you not to pay tax. And they for some reason, in small businesses, accountants feel their job is to keep you compliant in terms of the legislation, and then make your business, as they'll use the term, tax efficient as possible, which means basically you pay as little tax as possible. And they seem to think they basis their success in terms of the advice they're providing you on how little tax you pay, which I think is probably wrong. But I'm not an accountant, so what do I know? But when you go and see your accountant, or you have chats with your accountant, the accountant's always talking about the past. Your accountant's basically an historian of your business. Yeah? There is a significant data lag between the work that goes on in your business and the accounts being presented for the legal purposes to Companies House. Okay, and you often sit down at your end, having presented your accounts, and it could be 6 to 9 months later that your accountant comes to you with the, if you like, the books, and says this year's profit was X, Y, or Z pounds. And you go, oh, that's good. We made a profit last year. Yeah, you did. And your accountant says, yeah, you've done really well. You've made this amount of profit. And then you reach in your pocket or under your mattress or wherever it is you keep your money, and you look for that profit. It ain't there. It's already been spent, because it all happened 6 to 9 months ago. You didn't keep the money. And so if your accountant's or the business has been successful, an accountant's done his bit, he then comes and he sees, and you owe X in corporation tax. Ooh. So I was profitable. Oh, that was good news. But now I owe the tax man. Well, where's that money? Probably already spent it, as I already said. So can you imagine the playing a game, whatever it is, sport, any sport, and finding out the score 6 to 9 months later? Who'd watch that? You know what I mean? Who would go and watch a sporting event? The Super Bowl goes on long enough, doesn't it? If anyone watched that on the weekend, that goes on long. That's a long sporting event. At least there's an outcome. Everyone knows the result at the end of it. Who would go to a sporting event and then be text or messaged or sit down in a room, 6 to 9 months later and say, this is what happened? So your accounts generally are a retrospective scorecard of how the business done 6 to 9 months ago at the end of that year. So it takes 12 months to get there, and then 6 to 9 months later, you get the result. 12 months work, and you get the result 6 to 9 months later. How do you think that enables you to plan for the following year? Well, you're already 6 to 9 months in it. So if you're going to make some changes, you better do them quick to have any effect on that year, because you're halfway through it or more. So you might think, oh, hang on, but I don't rely on my accountant for my accounts. My bookkeeper keeps me abreast of where I am, and we use some reporting forms with them. And there are a number of financial statements that we'll talk about as we go through the training over the periods of time. But there's also a data lag with your bookkeeper. Now, your bookkeeper is slightly better than your accountant, but when your bookkeeper's posting invoices and returns, etc., a lot of that stuff doesn't happen at the time. So it's not real live data. There's still a lag. It's slightly better than your accountant. But if you think about it, you're paying your suppliers on either 30, 60 or 90-day accounts. So you don't know when you're square with them, because you're supplied with the goods and then you're paying them, and there's always a lag. Now, if you think about your returns and when you get the credit notes, etc., and all that's got to be posted, and you're probably looking at something called a profit and loss statement. And on your profit and loss statement, it tells you roughly how you're doing as a business, and it gives you those sort of turnover, your revenue, it gives you your gross profit, net profit, etc. That's on there, and you get an idea. But at best, it's 21 days behind, and so at least at best, and that's if you're really on top of everything, you'll be 3 weeks behind real time with a profit and loss statement when you're looking at it. Now, when we do the training on the three main, as I see it, financial statements, we'll have a look at the strengths and weakness of each statement in terms of how you use them within a small business. But you've got to remember what's not included on a profit and loss statement. And there's stuff that isn't included that's actually costing in the business. So it's worth noting that it's not a true reflection of what's happening. So even though it's better than your end accounts that your accountant provides for you, which are in a lot of cases a complete work of fiction, and they're done just to satisfy legal obligations. Because when you look at them, do you actually understand what those numbers mean? Do they represent the cash in your pocket? They probably don't. They are legally required and they are probably correct in terms of the legal aspect, but as a metric for your business, they're a work of fiction in most cases, unless you're really, 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 really clued up on what those statements are, those different financial statements are. Like I say, we'll do training on them at a later date. So if you're relying on your bookkeeper, be aware that you're at least, even with someone who's really, really efficient, at least 21 days behind, if not longer, probably more like a month to maybe 2 months behind if you're using the numbers your bookkeeper's giving you as a guide to what's happening in your business. So if using your accounts are not a reliable metric for measuring the financial success of your small business, what should you use? Well, I reckon you're better off with something that where the data leads instead of lags. So something where the data is predicting what's going to happen, and that's called a cash flow forecast. Yeah. And the way to build a decent cash flow forecast is to understand the financial nuts and bolts of the other statements, the other financial statements that you commonly use, and use that data to create what I call the ideal business model, or in some cases, the not so ideal business model. And you have all the financial inputs and all the financial outputs of your business, including stuff that isn't seen on the normal statements that happen in the day-to-day running of your business. And what you can do is once you've got that on a spreadsheet or on a piece of accounting software, there are various tools you can use for this. I just tend to use Excel, but then again, I am a data geek and I just kind of love that stuff. But it's not difficult once you've set it up. And what you can do is you can build a model of your business, and then you can start to change things in any of the sections and start to predict the cash flow through your business. That's why it's called a cash flow forecast. And what I like to build is 3 what if scenarios. So what if things go to plan? So hopefully you understand that if you've been looking at any of the training, I quite like plans. I like setting plans. And obviously in planning, we set a target for profit and a target for turnover. And we know it, once we start to understand the business a little bit more, what the percentage of turnover should be profit, etc., etc., whether that be gross profit or net profit. And we can build that into our ideal business plan so that we know what we need to do to achieve the correct turnover to get the if you like, the forecasted profit. And then I have 3 what if scenarios. So I have A, B, and C scenarios, if you like, 3 different plans. And they're what ifs. What if things go really well? What if there is a disaster? And the only reason I've started doing this was because of COVID, and it was a real eye-opener for me. Have I got 3 months reserve cash in the bank if I have to stop trading for whatever reason? Yeah. And then what if I make a investment, whether that be take someone on, lose a member of staff, whatever it is, and you can run the forecast straight through the ideal business model, and it'll spit out the numbers, and you'll know exactly before you do anything exactly what will happen if any of these scenarios occur, and then you'll know how to adjust your business planning in order to stay profitable, to stay afloat, to keep the cash flow going, because that's what the cash flow forecast does. So it predicts what's going to happen before it happens, and therefore you can measure how successful you're being in real time, which is much better than waiting 6 to 9 months for your accountant or 3 to 6 weeks for the bookkeeper, because it's not their fault, it's just how long that takes, because the information is in real time. So once you have your cash flow forecast in place, you know how much you need to put aside each month for your tax bill. You know how much you need to put aside in terms of profit, and what your break-even point is daily, weekly, monthly, or even quarterly, or even annually, from one piece, if you like, one spreadsheet, one piece of data will tell you whether or not you're on schedule, behind schedule, ahead of schedule, at any point in your business, because it is real-time data. And that is the metric we need. Rather than a retrospective scoreboard, we want a scoreboard predictor. Hope that helps. I've been Andy Crook. I was the creator of the Atomic Success Program. If anyone's interested in joining the program, comment, like, share, direct message me, whatever, and I'll let you know a little bit more about it. Thanks for watching. Stay safe.